Tuesday, May 5th, 2026. Silver suddenly dropped in just a few minutes.
It can't be! The shorts are getting squeezed!
Get me out of those positions now.
Between 2:47 p.m. and 2:51 p.m. Eastern Time, silver dropped sharply, while almost nothing else moved the way it normally should. Write this down. Silver fell aggressively, while gold stayed relatively stable. The dollar index barely moved, and Treasury yields didn't spike. That creates a contradiction. Silver drops fast, gold doesn't confirm, macro signals stay quiet. Those three things don't usually happen together. And when they do, it tends to mean one of two things. Either new information is being priced in very quickly, or positioning is shifting beneath the surface before that information becomes obvious. Now, here's where it gets interesting. The mainstream explanation says this was just routine volatility, a stronger dollar, higher yields, profit-taking, and yes, those factors were present. But when you actually compare the size of silver's drop to how little those macro indicators moved, it doesn't fully explain the move, and that's the key point, because when price moves don't match the data, you have to look deeper. When you connect this move to inventory trends, delivery activity, and the gold-silver ratio, that 4-minute drop starts to look less random and more like a signal. So now the question becomes, was this just a short-term reset or the early stage of something bigger? Because if it's the second option, then Friday's close might not mean weakness, it might mean repositioning. And you have the rest of this week, before markets open Monday, to decide how you interpret it. I'm Boring Stocks. This channel focuses on data-driven analysis using publicly available information, historical context, and structured frameworks, not predictions. Everything in this video is for educational purposes only. Now, let's break down what actually happened. Silver pulled back sharply during the most recent trading session. After trading near recent highs, it dropped aggressively in a short period of time. At the same time, gold remained relatively stable. Now, the mainstream explanation focuses on three things: a stronger US dollar, rising Treasury yields, and profit-taking after a strong run. And on the surface, that makes sense. Historically, higher yields and a stronger dollar can pressure metals. But here's the problem. When you compare the magnitude of silver's drop to the actual movement in those macro indicators, it doesn't fully line up. The dollar didn't spike dramatically, yields didn't surge aggressively, and gold didn't fall in the same way. So if the macro conditions don't fully explain the move, what does? This is where the deeper data starts to matter. Let's break this into a few key points. First, volatility. Silver is naturally volatile. 3 to 5% moves can happen, but they usually happen when something bigger is moving the market. That didn't clearly happen here. Second, futures markets. Silver pricing is heavily influenced by futures trading, and when large amounts of volume hit the futures market quickly, prices can move sharply, even without changes in physical demand. That suggests this move may have been driven by positioning, not fundamentals. Third, trend context. Even after this drop, silver is still elevated compared to where it was historically. That tells you the broader trend hasn't fully reversed. And fourth, expectations. Institutional forecasts still show mixed but generally elevated expectations for silver. So when you combine all of this, the move starts to look less like panic and more like adjustment. To understand this properly, you need to understand how silver works. Silver is both a monetary metal and an industrial metal. That creates cycles. When liquidity increases, metals rise. When industrial demand increases, silver gets additional support. But supply doesn't respond quickly. Mining takes years to expand. So when demand rises faster than supply, you get tension, and that tension shows up as volatility. Now, based on where we are today, demand remains strong. Supply growth is limited, and investment flows are inconsistent. That combination creates instability, and instability often shows up first in price swings. Now let's look at the physical side. Dealer data shows that premiums can rise during periods of strong demand. Delivery times can also fluctuate. This doesn't mean there's no supply. But it can mean supply is tightening, and that's important. Because markets don't need to run out of metal to show stress. They just need to tighten. At the same time, futures markets continue to handle physical delivery through settlement, so the system is still functioning, but it's not perfectly smooth. Now we get to divergence. Paper markets move fast, physical markets move slower. When those two start to disconnect, it can signal short-term mispricing or a deeper structural imbalance. Historically, these gaps don't last forever, but the timing of when they close is unpredictable. Supply and demand, $1,530 to $1,700. Supply grows slowly. Demand can change quickly. If demand stays strong and supply doesn't keep up, something has to adjust. That adjustment can come through price, but it doesn't happen instantly, and that's where uncertainty comes in. Now let's be fair. There are real risks. Higher interest rates can pressure metals. A slowdown in industrial demand can reduce usage, and a strong dollar can limit upside. All of these are valid, but they are also variable. Rates change, demand changes, currencies change. So the debate isn't just direction, it's timing. Here's what to monitor going forward. Watch silver price trends, watch COMEX inventory levels, watch the gold-silver ratio, watch the dollar index, watch treasury yields, and watch industrial demand indicators. Now, the risks. Prices can go lower. The timeline could take longer than expected. Liquidity can become an issue in physical markets, and this entire framework could be wrong. This is educational only, not financial advice. Today is Tuesday, May. Here's the bottom line. Silver's recent drop may not be fully explained by macro conditions. Futures positioning suggests short-term pressure. Physical signals suggest intermittent tightening, and the broader structure remains unresolved, so Friday's move might not mean weakness, it might mean adjustment. Now here's the question for you. Do you think this move was driven more by macro conditions or by positioning beneath the surface? Leave your framework in the comments. I'll pin the strongest arguments on both sides. If you found value in this, like the video, share it with someone following the metals market. Subscribe if you want updates as this develops. I'm Boring Stocks. Today is May 5th, 2026. See you next time.